Commissioner, thank you so much for having us.
It's a pleasure to be here.
So, one of your chief goals, as you've stated, is to, quote, restore fairness to the tax system. What do you mean by that? Fairness.
Yeah, what I mean by that is making sure that the IRS has the capacity to determine what people owe, regardless of what their income level is. And for years, the IRS was underfunded. And when we were underfunded, we lost capacity to figure out what was going on with complex tax returns. We didn't lose that much capacity on simple returns. So if you had a middle, low-income taxpayer, even when we were underfunded, we could figure out and determine together with the taxpayer what was owed. But for complex filings, it became increasingly difficult for us to determine what the balance due was. So to ensure fairness, we have to make investments to make sure that whether you're a complicated filer who can afford to hire an army of lawyers and accountants, or a more simple filer who has one income and takes the standard deduction, the IRS is equally able to determine what's owed. And to us, that's a fair system.
So does that mean that because of the lack of resources and the complexity of those high earning returns, that audit rates for the highest earners, partnerships, large corporations, fell the most?
Our audit rates are anemic across the board prior to the Inflation Reduction Act. What we have determined is that where the important capacity building needs to be is for those complicated returns.
And why, though? Because there are some who say you're just picking on those at the top.
Yeah. Well, first of all, I should emphasize that many, many taxpayers that have complex returns are doing everything right. And they're filing, accurate and complete returns. And what we want to do is make sure we're investing in capacity so that when we select a taxpayer for audit, we're avoiding those that are doing all the right things, and we can let them keep doing the right things. The issue is one of fairness. And the issue that we see at the IRS is in a variety of different areas. We have reduced capacity to see what's going on, and these are areas where we think there's risk of non-compliance. And that's why we're prioritizing this space first. So it's high wealth, but not all high wealth. High wealth where we believe there's a risk of non-compliance.
And why $400,000 a year as the cutoff?
That cutoff was articulated by Secretary Yellen. I think that is a space where the Secretary and her leadership team and others felt would be the right demarcation to send that message to the American people that, a lot of Americans that are middle, low income make nowhere near $400,000 a year. And by setting that line at $400,000, they could even feel more secure that the goal of the IRS with the Inflation Reduction Act resources is not to increase audit scrutiny on them. So I think $400,000 is a safe distance away from where most taxpayers are. And they should know that when I get up in the morning and go to sleep at night, where my focus is from an enforcement standpoint is in those high-risk areas amongst the largest corporations, the largest complex partnerships, and millionaires and billionaires.
Could there be some people engineering their income to be just at 400 or below to get through what they see as the, it's going to be, 1 in 500 chance of being audited if you look at the 2018 baseline if you're under 400,000, and yet it could be 10 times that if you're $1 million, $2 million. So could there be people gaming this new demarcation in income when it comes to audits and scrutiny?
There's always that risk, but that is very low on my to-do list.
Yeah.
Our to-do list is really at a much higher level of income. Corporations that have 250 million or more in assets, partnerships with 10 million or more of assets. And again, many of them will not hear from us, if they're doing the right thing. It's really trying to zero in and making the investments so that we're uncovering the income that's being shielded. Because when I talk about complexity in tax returns, and when you talk about complex partnerships, you've got subsidiaries and pass-throughs, you've got money moving across multiple jurisdictions, now you have money in multiple currencies. In the wake of that complexity, it becomes easier to shield your income. And fairness in tax system means that the IRS is building capacity to make sure that that shielding is unsuccessful.
Yeah, and I want to get to that complexity, especially as it relates to partnerships in just a moment. Going back to the 400,000, the majority of money recovered from audits in the past has come from people with incomes below $200,000. Now, that's not a dollar per audit, because obviously the dollars per audit is going to be at the higher income, but the overall majority of money that's recovered from an audit, I don't know the technical term, comes from those under $200,000. Wouldn't that contradict your impulse to go and say, if you're under 400, don't worry, you're going back to the baseline of 2018. Above that, you're going to get more scrutiny. Is that going to generate enough income?
It is. Fairness in tax enforcement means that we have to have balance across our entire portfolio of taxpayers. And when I look at what we call our tax gap, which is the amount of money owed versus what is paid, for millionaires and billionaires that either don't file or are underreporting their income, that's $150 billion of our tax gap. There is plenty.
Per year?
Yes. There is plenty of work to be done. And in doing that work, not only are we going to help the United States' financial situation, but we're also going to build trust that we're not just focusing on middle and low income. The opposite. That we're really zeroing in on taxpayers. Again, those that have the means to be able to hire accountants and lawyers, that's great, especially if those accountants and lawyers help them reach an accurate and complete return. But within those taxpayers, there are certain taxpayers that are inappropriately shielding their income. We have evidence of it. Now we need to go in and do a better job of identifying it and collecting it. And that's going to benefit all Americans at all income levels, because if you're high income and you're playing by the book and you're doing the rules the way you're supposed to, and the IRS is not monitoring your competitors who are not doing what they're supposed to, that's not fair either.
When you look at private jets again, private jets, you have depreciation, if you charter your plane, you can essentially sort of lose money for 9 out of 10 years and take those losses. And then, of course, the big one, which you talked about, is using it for personal use where you're deducting it as a business expense. What would, in the simplest terms, what would you say is probably the number one abuse that you will find or suspect is out there when it comes to private jets?
I think it's sloppiness with your record keeping. Not paying attention to when you're using the corporate jet for business purposes versus personal purposes, documenting that, and then making sure that when you take your business deductions, you're taking business deductions based on the amount of time that corporate jet was used for business versus personal. Look, there are
when there are people that I know who, let's say, they have a vacation home in St. Bart's. They also co-own a gallery in St. Bart's. Maybe they just happen to own a gallery, or maybe it's a business that they can visit with their jet to justify flying to St. Bart's. But isn't it going to be complicated for the IRS to say, okay, yes, you have a business in Nantucket or the Bahamas or St. Bart's or wherever they're flying to that's not their main home, but we don't think that the reason that you were there was business, and we don't think it justifies. Isn't it going to get, when you go flight by flight, visit by visit, where did you go as soon as you landed? Isn't that going to be, relative to the amount of revenue you'll raise, a lot of work?
This is a complex part of the tax law, but we have rules that help guide you in terms of that exact hypothetical that you provided. You can go to IRS and Treasury regulations, and it will set out a set of instructions on what to do. The issue is that not enough taxpayers are sitting with those instructions and doing the diligence to make sure that they're tracking their corporate flights, their personal flights, and then what to do when they're mixing both business and pleasure on a trip. And look, why this is important. There are more than 10,000 corporate jets operating in America today. Many of them, most of them, worth tens of millions of dollars. The depreciation schedule on those is front-loaded all in the first 5 years. What does that mean? That means when these individuals and companies issue their tax returns, their deduction on corporate jets can be tens of millions of dollars. It is material. We need to make sure that it is right and correct. And that's why we're focused on this, because we know that record keeping on this has historically been poor. We know that there are a certain segment of taxpayers that are not doing their diligence in making sure they have it right. And then you look at the tax return and you see how material the deduction is. And you say, not only is it important to do it because it's the right answer, because it's meaningful to what gets returned to the US Treasury, but it also is meaningful to build trust with taxpayers that we're taking our job seriously and making sure everybody plays by the rules.
Yeah, and when you talk about meaningful in terms of revenue, another area that you've focused on is delinquencies. And this is taxes that the taxpayer has admitted or at least been assessed that they owe.
Yeah, there's no more dispute.
Has not paid, and they're what, like 1,600 millionaires and billionaires that owe how much? And how much have you collected of that so far? And how is it so hard? Isn't there a process at the IRS for liens and garnishing wages and all that stuff to let it get to the size that it got?
Yeah, well, this comes back to the capacity for the IRS to do its job fully and completely. And when you're under-resourced, you have to pick and choose what you're working on. Sometimes it's really just about keeping the lights on in terms of making sure the tax system is moving forward, and you deprioritize things that you would otherwise feel like are no-brainers to get done. Well, once the Inflation Reduction Act was enacted, we no longer needed to deprioritize things like this. So we said, where do we have an immediate opportunity to collect money that's owed and to do it in a way that sends the right message that there's fairness in the system, and to put millionaires and billionaires who are delinquent on their debts on notice that we're no longer deprioritizing. And so yes, we created a high-risk list of 1,600 millionaires and billionaires who, no more dispute, it's a tax debt, they're just delinquent in paying it back. And so far we've collected nearly $500 million, and we're not done. And then there's more work to do. It's not just that these 1,600 millionaires and billionaires and their delinquent tax debt are the only areas of non-compliance. Again, I'm focusing on the end of the high-risk spectrum. Every time I do that, I have to be thoughtful about the fact that there are many other parts of the spectrum where people are paying their debts on time, and we want to make sure that we're focusing where we should, which is where there's a problem versus where we shouldn't, where things are complete and accurate. And
another area where you think there's a problem, clearly, is the large partnerships. You've started this large partnership compliance effort. What is it? These firms are ones with 10 billion or more.
10 million or more
10
in
million
assets.
or more in assets.
But where we've started is with the largest partnerships.
Okay.
So we've really, when we've pulled our first audits, these are for some of the largest partnerships in the country. And again, one of the things that...
And when you say large, are we talking like hundreds of millions in terms of assets?
Yes,
okay.
We're talking like some of the largest. So we're talking way above 10 million, hundreds of millions, sometimes billions in assets.
Okay, and these are, I mean, just to make it concrete, these are what, hedge funds? These are law firms. These are
real
REITs,
estate firms.
Real estate.
Yeah, exactly. And what I discovered when I got to the IRS was that not only was our audit rates anemic here, but we had oversight entities telling us, IRS, you're not auditing enough these large, complex partnerships. And when you're not doing that, you're creating an environment of higher risk. You're not out there explaining to taxpayers where the lines are that need to be drawn. You're not policing the complexity in a way that makes sure that there are the right rules so that all these substantially complex large partnerships are playing by those rules. So we are moving into a space that has been historically, seen little oversight, and we have hypotheses of where some of the bigger issues of noncompliance are.
What's one example?
Well, one example is
of a noncompliance issue that you think is out there.
Well, it's kind of misstating some balance sheets that tell us that there are valuations that we need to look at more closely.
Meaning what? That they would be essentially underreporting income? Or like explain how that
Yes.
works. I know you talked about when there's an increase in the balance sheet of more than 10 million and they haven't accounted for that. But what exactly does that mean?
Yeah, so when we see discrepancies in the balance sheet that we can see just from public reports,
I see.
it indicates to us that there is, a different set of reporting that may be going on that needs closer scrutiny to determine whether the taxable amounts are fairly reported. We also see with partnerships, kind of a lot of movement into different subsidiaries, and we want to make sure then when that money is moved around, that it's done in a way that's following all the rules. So again, the more complicated a partnership is, the more risk there are that within that complexity, money can be shielded.
The number and share of taxpayers that report through partnerships or pass-throughs has, just exploded.
Yes.
Why is that?
I am not fully aware of all the reasons, the economic reasons why that might occur. And I believe that often they can occur with all the right inspiration. Whether you're running a partnership, you're a CFO of a company, you have a fiduciary responsibility to find the most tax advantage status for your board, for your shareholders, for your equity partners. And that is something that the IRS is fully comfortable with. The issue that we have to be on top of is that if you're going to start disassembling your partnership into smaller pieces, moving and transferring money on different balance sheets within those subsidiaries, we need to be knowledgeable about when those activities are creating risk of tax non-compliance. And that's really what we want to do. And that's all about fairness. Again, for the medium and small size partnership that's paying what they owe, that has a more straightforward set of books, I think they want to know that even if you go super complex, doesn't mean you can get out of paying what you owe. If you're an individual and you are claiming income as part of a limited partnership, it has a more preferred tax advantage status versus you're reporting it to yourself. And what we started to see was there's certain taxpayers were claiming limited partnership when it wasn't there. And so they were basically shielding their income under the guise of a limited partnership. Not everyone, but it was happening. And so one of the things we've announced is a crackdown on, and these tend to be very wealthy individuals who are moving income into the limited partnership space in order to shield it from taxability, and we want to crack down on that. And most Americans don't have that option.
Right. What if you're a high earner or you have a complex return? What would you say are the sort of 2 or 3 red flags that the IRS would be looking for to say, you know what, based on the way we see the world, these are high risk issues? So for our audience, which is a fairly affluent audience, what are the things they should know are going to be a red flag for you when it comes to the potential of being audited as they're doing their taxes right now?
Well, we are trying to be transparent as we can in terms of what are some of our emerging focus areas. So, red flag, your use of corporate aircraft. Red flag, your assessment of your income as to you, the individual, or you as a limited partner. These are, we are laying out with increasing frequency what we're calling our high-risk areas that we are making sure there's a cop on the beat to make sure that people are paying what they owe. And I would hope that industries and your viewers are paying attention to these high-risk areas, and they could look at related areas, because once we gain momentum...
What would a related area be, for instance?
Well, I mean, other types of corporate assets and their depreciation schedules, and making sure that those depreciations are full and complete in business versus personal.
It sounded like from your press conference on this that you have the ability now in the analytics side to actually track corporate jet and private jet flights. And I know we have all these websites now that track somebody's jet. Is Is that part of the data that you're using? Because you can say, okay, this tail number is owned by this company, and we saw it went to Nantucket 4 times in August.
Yeah.
And I mean, is that something you can?
It's a great question, because one of the challenges that was presented to me when I was going through Senate confirmation to be IRS Commissioner was, how do you use data effectively to do your job without overreach? Right, so I got a lot of questions. Are you going to reach into people's bank accounts unfairly? Are you going to intrude on people's private information? And the answer is, we're going to find the right balance. We're not going to do unnecessary intrusions. We're going to look at what authorities does Congress give us, and we're only going to operate within our authorities. And as it turns out, there are obtainable databases out there that the IRS can obtain and other members of the public can obtain that are perfectly legal to obtain. It's really 2 things. It's getting that database and having the wherewithal and the focus to bring that database into our environment. And then it's the advanced data science and the analytics to make sure that when we're pulling these audits, we're pulling the right audits. And so it's those 2 things together. But it's balancing, because I find it very important as part of trust building to make sure that people don't have the impression or that there's any evidence to it that the IRS is going outside of its legal bounds in terms of the data we collect to do our job.
Right. And again, I mean, I assume that data includes private jet flights.
That data includes private jet flights, which is out there. And the IRS can get it, and others can get it too.
And that data is only recently available. In other words, 10 years ago, that wasn't a tool that the IRS could have had, maybe.
Robert, you could say that about a lot of things, right? We're living in an expanding information age.
What about AI? Where do you, I know you've talked about using AI to identify certain kinds of complex tax returns and to find out if there are patterns in there as to where the high. Tell us about what AI can do for the IRS and how you're using it.
Well, if you indulge me, I want to give a metaphor,
yes.
Which is, imagine all the audits were laid out before us, the potential audits on a table, right? And what AI does is it allows us to put on night vision goggles. We currently don't have those night vision goggles. What's going on in this complexity is there are things that we can't see without improved vision, improved insight. So what those night vision goggles allow us to do is be more precise in figuring out where the high risk is and where the low risk is. And that benefits everyone, because if you're playing by the rules, it means the IRS won't be reaching out to you. Without those night vision goggles, there's an increase in risk that we're going to reach out to a taxpayer that's doing everything right, and we're going to waste our time and their time. And so when you think about AI, think about the data science, understanding that in that complexity, you've got a company that's operating in 13 different tax jurisdictions. They have all of these different subsidiaries and wholly owned subsidiaries. They're managing in various currencies. Their balance sheets are extremely complicated. And in that, we have to find where the corporate officers are playing by the rules and where they're not. And AI, which is really about advanced analytics, is turning that light on in a way for us that allows us to see the non-compliance more clearly and therefore select the right cases for audit.
Commissioner, thank you so much for your time.
Thank you.
Appreciate it.